What's up, everyone? It's Scotty with Money Investing. Welcome on board for another Market Open live stream. Just give me a thumbs up if you guys can see me and hear me, and we should be all set and all ready and all good to go. We got the NASDAQ ETF down a little bit over 25 basis points. However, we are still recovering a little bit. So yesterday was a very strong day. Today we gapped down. At one point, we were down over 1%, but then a nice recovery pre-market here. SPY also pulling back over 63 basis points, and the Dow Jones is one of the ones that's getting hurt the most, down over 85 basis points as well. Volatility is higher. We're up over 11%, although we were much higher at up over 18%, trading past over 27 levels. And as the markets have recovered a little bit pre-market, we've seen the VIX also come back down, but still pretty elevated, staying above that 25 levels. We almost got up to as 29, almost 30 bucks for the volatility before coming back down once again. Oil is on a nice drop here. We've got Brent dropping under $71 a barrel, down over 4.3%. And then we got crude also down over 4%, coming down to that next support at $66 a barrel. So both Brent and crude selling off quite a bit, with the RSI also coming down to very, very oversold levels. And on the flip side, we got Ethereum now starting to break out to the upside over 4,500. We got Bitcoin also now starting to almost retest that resistance at $59,000 once again. So thank you so much for joining in. Markets in Europe, so UK 100, so FTSE 100 has recovered a little bit, still down about 80 basis points. And we got the DAX still down about 37 basis points, although we have recovered quite a bit. At one point, they were both down over 1.5% each. So we got a lot to cover in this video. Let's just quickly break down some of the earnings. So Salesforce and Zscaler reports earnings after the bell today. So those are the two companies that are going to be very important for us to keep a close eye on. Salesforce, I did a separate video on this company as well, kind of going over what the company does, what type of growth are we looking at. The earnings are expected to actually decline for the company, but revenue is still expected to be on a strong trajectory. And of course, it's one of the biggest SaaS stocks in the world, so we'll be keeping a close eye on that one. And of course, Zscaler in the cybersecurity space, we'll be watching that stock as well. And then HP also reports after the bell today. So that's that. Ray Dalio says cash is not a safe place right now despite heightened market volatility. So this is not new news. Ray Dalio has been, Bridgewater Associates, one of the biggest hedge fund managers in the world, has obviously been against cash since the beginning because of inflation. And he essentially says cash is not a safe investment and it is not a safe place. It will be taxed by inflation. And reading further, Cyber Monday online sales dropped 1.4% from last year to 10.7 billion, falling for the first time ever since 2012. So Adobe Analytics essentially tracks this. And last year we saw retailers bringing in $10.8 billion in sales on the web, and that was because of work from home trends back in 2020. And so far, since 2012, they've essentially brought in closer to 1 trillion visits on retailers' websites. But this year, it was a little bit down, just 1.4% to 10.7 billion. In my opinion, that's more or less the same as last year. And it marked a record day for e-commerce purchases in the United States last year because of the pandemic. But this year, we're seeing a little bit of a pullback, down about 1.4%. So I told you you would be all here when you got back. Great guy, great content. Thank you. I really appreciate that. So JP Morgan is out with an official 2022 outlook that sees good things for the market. And before I essentially release the outlook, we need more people kind of joining in here. We've only got less than 100 people right now. But JP Morgan coming out with a new target on the S&P 500, which is very interesting. We'll go over what their upside looks like for the S&P 500, which of course this is the first official target that we're getting from a bank on Wall Street for 2022. Any guesses? Any guesses before I break this down? What are your guys' guesses? So let me know in the live chat what you guys think, where the S&P 500 is going to be according to JP Morgan in end of 2022. Just want to give it a couple seconds here. Just want to read from you guys and see if there's any guesses that you guys have for the S&P 500 for next year. So what is the target? What is the S&P 500? Right now it's roughly at 4,700. What do you guys think? What is that number are we looking at? So yeah, I mean, they do have a bullish target. They obviously do not see the market's coming down next year. So definitely, so 5,000, that's the first one we get. 6,000, another one. 6,000, we got a couple 6,000 targets. So it's actually it's actually not in the middle. So it is closer to 5,050. So next year, JP Morgan expects S&P 500 to reach 5,050 on continued robust earnings, Growth as labor market recovery continues, consumers remain flush with cash, supply chain issues ease, and inventory cycle accelerates off to historic lows. JP Morgan's, I don't even want to pronounce that name, wrote in his 2022 Global Equity Outlook, released Tuesday. And here's the interesting thing. Most of the equity upside should be realized between now and the first half of 2022, when monetary and fiscal policy tailwinds will be the strongest, followed by a sideways action in the second half of 2022. So if you were to look at the S&P 500 now, it's trading at roughly 46.55, and giving it a 5,050 target, we're looking at a potential upside of closer to 8% for next year, which is actually quite average for the markets. Of course, this year has been very, very strong. 23, almost 24% upside for 2021 and 2022, according to JP Morgan, which is one of the first ones to give out an official guidance for next year. It sees an 8% rally for the S&P 500 to 5,050, and most of that coming in from the first half. And then when rates start going higher, that's when they see a little bit of a sideways action for the markets. They also added that they expect central bank policy to remain broadly accommodative, and the bank's S&P 500 earnings per share estimated for full year is $240 compared to the consensus estimate of $222. So $240 based on a $5,050 target gives us about a 21 times earnings for the S&P 500, which is, again, quite average, right? In the past, we have traded at higher multiples, but 21 based on 2022 earnings is quite reasonable for the markets. And there's a compelling case for inflation rotation versus broad-based acceleration in prices as well. He added that tech stocks could face equity multiple pressure from higher rates, but should continue to deliver strong fundamentals as well. So Fed's Powell to tell Senate new variant poses risk to economies. So Jerome Powell's speech is coming up at 10 a.m. Eastern, so in about an hour or so. Treasury Secretary Janet Yellen is also going to be participating, and we'll see if we can find a link to essentially watch that live. And then President Joe Biden also said on Monday that he doesn't expect the U.S. to impose any additional travel restrictions. And here are some upgrades and downgrades from Wall Street as well. So Bank of America upgrades Square to neutral from underperform. Wells Fargo reiterates Boeing as a top idea. JP Morgan reiterates Facebook as a top pick. JP Morgan's been really busy today. UBS reiterates Microsoft as a buy. JP Morgan once again reiterates Netflix as a top pick. JP Morgan reiterates Amazon as a top pick as well. And represents about 20% adjusted retail sales growth, and we estimate 15% of workloads are in the cloud today. And then we got Morgan Stanley reiterating Amazon as overweight, so a couple Amazon upgrades on the day. Bank of America reiterates Twitter as a buy. And the bank said it will take time for investors to get confident with the replacement, which the CTO now is going to be the new CEO of Twitter, and Jack Dorsey is stepping down. And they essentially have a fourth quarter guidance of 2023 targets. We think Twitter remains attractive at 6 times sales, below our 5 company sector average multiple at 8.4. So we are seeing a little bit of value compression for Twitter as well. Then you got Mizuho reiterates Chevron as a buy. And that pretty much wraps up our market briefing. And we got about 5 minutes left. Perfect timing for the markets to open here. With the NASDAQ now pushing higher, almost break even now, down only 17 basis points. SPY still down about 0.5%. We got the Dow Jones pulling back over 67 with the volatility coming down. Still in the green, up over 11%, but pulling back from high of days here. All right. Let's see what you guys are talking about. So let's see. Printer is coming, yes. So Jay Powell is going to be talking very soon here. Let's take a look at Alibaba. Let's see how that stock is doing right now. Wow, down another 1% to $130. How is other Chinese stocks doing? So NIO down about 30 basis points. JD.com is down 1%. Let's take a look at Tencent. So down about 9 basis points here. How is Baidu doing? So Baidu is also down about 1%. So a lot of Chinese stocks essentially down over 1% here. I think it's very normal because the markets, Dow stocks, S&P stocks, they are pulling back as well. So Baba, expected to open and hit another 52-week low, which is going to be about $130.16. I mean, this has just been absolutely incredible. We are literally at 2018 levels. So in over 3 years, this is the first time Alibaba is retesting lows of $130 per share for the company. Fundamentally, as I've already mentioned, remains essentially undervalued, but the stock price is under pressure, right? Fundamentals can be phenomenal, but the stock price is different. Stock price is just market's sentiment towards that company, which of course is under a lot of pressure with some of the regulatory issues that they're seeing. as well. And as I've already mentioned, the probability for us to see a delisting of a stock like Alibaba are very, very low. I mean, Chinese regulators, I broke that down. Reuters came out with that article, essentially said that they're working with the U.S. regulators to make sure that they don't actually see some delisting of these companies, because we're talking about trillions of dollars at stake here, and there's both countries' interest kind of intertwined with each other. So I don't personally see delisting as being an issue. It's more noise than an actual material impact on the company. I mean, I would be shocked to see if a stock like Alibaba gets delisted. But in a world like today, anything is possible. So obviously we can't completely rule that out, but the probability is still very, very low, in my opinion. So what's the best financial stock to buy in your opinion at current prices? So we're waiting on JP Morgan. Maybe today is the time. Today's the day. We actually are going to be able to buy 160. So I might already be in this. I might have to double check. But 160 is when I actually started a position JP Morgan. I will be buying more. This if it all comes down to 145 here. If it drops even further, JP Morgan will be a buying opportunity in my opinion as a financial stock. Interest rates start going higher next year. We're probably going to see 2 rate hikes. That's kind of like the consensus estimate. And we will potentially be able to capitalize on that as a net interest margin increases for companies like JP Morgan, because they're going to be charging higher interest on their customers and still be paying a small amount on the savings and of course cash as well to depositors, right? So that's their profitability increasing for the company. So just as a rule of thumb, interest rates when they go up, that benefits banks. And we are in an environment where interest rates are about as rock bottom as it gets. So there's only one way that they're going to go. It's only up, right? They're only going to be going up. That's the only direction that's left for interest rates. And eventually when that happens, that is going to benefit companies like JP Morgan, Bank of America, some of the retail names, not so much the investment banking names because they're more on the M&A side. But retail banking, anything related to lending, is going to benefit from that. So JP Morgan for me is a stock that I would personally be looking to add more of in the banking sector. PayPal. Yeah, PayPal is down under 27 basis points. By the way, let's just quickly get ready here. We're going to open up the NASDAQ, the SPX, and the Dow Jones. We'll pull up the 5-minute charts for these. And I also want to look at some of the relative charts today because I think it's important for us to keep track of those and really understand how the S&P is doing, how the NASDAQ is doing on a relative basis, and of course different sectors of the S&P, the NASDAQ as well, and how they're doing as well. So, all right, the Dow opens down 80 basis points, the S&P opens down 0.5%, the NASDAQ still yet to open here, just needs to refresh here very quickly. There we go. So down about 42 basis points. And what do you guys think? Quick poll, red or green? What do you guys think? Where are we going to end up on the day? With the VIX also up over 11%, but I want to hear from you guys and what you think is going to be the outcome for today for the markets. I think the yields were lower today again. So we got the 10-year yields now under 1.45. So we're trading at 1.443. We are down about 3.8%. What is one thing that's happening when the yields are down? Can anybody tell me? So a lot of reds. See a lot of reds right now. But what is the one thing that happens when the yields are coming down? What is that signal? What is the market telling you when the 10-year yields are down? So let me see what you guys have to say. Bonds up. So yep, exactly. Bond prices are up, right? So TLT is pushing higher, up over 1%. That means investors moving towards bonds. They don't want anything to do with risk assets. They're moving away from equities over to bonds because bond prices move higher, yields come down. So again, that is only going to be a temporary measure because nobody wants to stay in bonds at this inflation, right? Inflation when it's up over 6%. Why would somebody buy bonds when it's only yielding 1.45 or 1.44? It's only a temporary move, maybe for a few days, maybe for a few weeks until we kind of weather through that volatility. But eventually people tend to move back over to equities because, as covered earlier, Ray Dalio said cash is not the place to be because of inflation, and bonds also is not the place to be because of inflation, right? So where are you going to be? Real estate, equities, those are some of the assets that are going to yield higher than inflation. So again, that's, in my opinion, more of a temporary move. And as I've mentioned also for the volatility, it's not going to stay at these levels forever. In fact, I mentioned that in our Discord today. Don't let this VIX spike go to waste, right? Buy something. In my opinion, if the VIX is higher here, it's an opportunity to kind of buy some stocks because when VIX comes down, that's when the S&P, the NASDAQ goes higher. So, we see these spikes very rarely. I don't want to say rarely, but up to highs of 30 levels, that doesn't happen like quite often. The last time we saw that was back in September. The time before that, was back in May. And the time before that was around March 2021, and before that was January. So it's very few times we actually see the VIX spike like this, but eventually it always comes back down. As a result, the S&P, the Nasdaq start pushing higher. We're already starting to see that, right? You'll notice a VIX coming down. It's only up over 9%, and we got the markets starting to rally higher. So don't let this VIX spike kind of go to waste, right? So start dollar cost averaging. Again, it's a slow and steady process. So obviously, I'm not asking you guys to go all in and start buying, but just understand that it's not going to be sustainable. Eventually, we have to be long on the markets. Let's take a look at Tesla. Up over 1.5%, so back over 1150. This right here is kind of like a symmetrical triangle that we identified yesterday in our market update and our live streams. And right now it looks like we are now just starting to creep a little bit higher from these levels. 1250, 1245 is still going to be that all-time high and that resistance to watch for Tesla. Support level is going to stay put at close to $1,000, kind of aligned with that 50 EMA as well for the markets. Facebook still down over 1.3%. The next moving averages are going to be at 328, kind of aligned with that 200 SMA, all the way down to $309, kind of aligned with that 300 simple moving average as well. So Tesla, Facebook, how's NEO doing? Up just over 30 basis points, so nothing crazy. Let's take a look. So Mara back over $53 because of how well Bitcoin's been rallying. So from recent dip of 53,000, we have rallied up over 9.8, almost 10%. Here's another test for Bitcoin once again, and that is going to be at 59,000. The real question once again is going to be, are we going to break out over that resistance, or if that's going to be another rejection for Bitcoin back down to retesting lows of 53,000. So previously we have gone rejected at that level a couple times, and this is the third retest for Bitcoin. Ethereum's already on that breakout over 4,500, so that's good. And we're already starting to break out over this previous resistance for Ethereum as well. Alan, love your channel. Watch it every day and night. Thank you. Thank you. I really appreciate that, and glad I'm able to help. And all the stuff is really helpful for you. So thank you. I appreciate that. S&P still down. Dow Jones recovering a little bit, and Nasdaq also red. Let's take a quick look on different stocks. So Trulieve, unfortunately, selling off even further. So down. Actually, no, that's a little bit delayed. My bad. This was actually yesterday. Pre-market, we're pretty much flat. This will open in about 6 minutes. QuantumScape down. Alibaba's down, hitting new 52-week lows at about $129 a share. This absolutely incredible. Facebook down over 1%. Nvidia pulling back a little bit over 1%. Then we got SoFi down. Alta. SoFi, $17 is still that support level. By the way, swing trade idea here for SoFi seems like a very incredible opportunity in my opinion, just considering how much it's sold off from $24. I did a couple other videos on SoFi, so make sure that you do check out that video as well. But RSI, coming down to oversold levels just under 40. MACD's been selling off as well. Two support levels to watch if you're interested in SoFi: $17.30 all the way down to $15. Those right there are going to be two levels to keep a close eye on for this company. Just considering how much it's sold off and now finding support, consolidating sideways, we could see a potential upside here on the company as well. So that's that. And we got Qualcomm, Twitter, just about down, flat, nothing crazy. Then we got Fiverr, flat. Take-Two Interactive, flat. Palantir, flat. So Shopify, 1621. Nice move on Shopify here so far. Mara's pulling back a little bit, just under $53. Then we got Trade Desk. Pinterest is up. Pinterest has just been really brutal sell-off, right? 52-week lows yesterday. I think it traded all the way down to $40. And it just continues to sell off. And there's still some decent positive divergence or that bullish divergence. So you'll notice the RSI is obviously not going as low as it did on August 17th, but just the price action. I mean, absolutely getting hammered here for Pinterest's price action. Just so much coming down. So how do you dollar cost average on stocks like Google, Amazon? When you portfolio at 40,000, you only got 4,000, 10% in cash. That's a great question. So depending on the portfolio sizing, you have to kind of work your way around that. So obviously with a $40,000 portfolio and 10% in cash, you can't like buy Amazon and Google and some of the higher priced stocks. I'm not really sure about fractional trading, if you can actually do that on your brokerage, but it all depends on your percentage allocation. Don't look at it in terms of dollar amount and in terms of the prices for the stocks, but if you have fractional trading, you can buy fractional shares. It all comes down to the percentage allocation that you have for a specific stock. So with whatever amount of capital you have, X amount of capital, and you have 10% in Amazon, if you're comfortable with that, that's great. If you want that to be 12% or 14 or 16%, then you can start to buy a little bit more relative to your portfolio. If you think it's a little bit overweight, then you can cut down on your position in Amazon and look for other stocks such as Google or any other stocks that you find interest in. So percentage allocation is very important. When you're building a portfolio, look at that percentage allocation for that specific stock. If you're comfortable with that, great, hold it. If you're not, you can increase it or decrease it by buying or selling depending on your situation. So that percentage allocation is really important. All right, let's see. So Southwest has obviously been selling off as well. All the airlines are, right? So with the new variant, it's not a surprise. Of course, the new variant is putting a lot of pressure on a lot of airline and recovery stocks. Of course, it's just been making lower highs and lower lows. $43 is going to be that next support level. Out of all the airlines, by the way, I was watching CNBC, a lot of really good analysts kind of talking about Alaska Airlines, and there's also another one that I forgot what the name was for South American Airlines, and they also foresee them doing really well. What is that ticker symbol? ALK. So Alaska Airlines, with another very, very good balance sheet company, apparently, similar to Southwest. It has very similar characteristics. So let's take a quick look. So not the best, but it's still on a relative basis compared with American, United, and some of the other airlines. It's a decent, right? Just under $3.2 billion in cash, just a little bit over $4 billion in debt. So I will actually be doing some analysis on this one as well. It's not international. It's more like a, very concentrated, contained airlines. So I will be looking into this. But Southwest, in my opinion, still remains one of my top picks for recovery that we can take advantage of. And of course, with a strong balance sheet, with recovery in terms of revenues and earnings as well, with the travel demand coming back in. Obviously, we don't expect the travel demand to be 100% as it was pre-pandemic. Some of the more work from home trends have shifted that. I think it's going to be more like leisure, pleasure travel. And of course, the business that cannot be conducted over Zoom still needs to happen in real life and in person. So I think that's still going to recover, but that just that small population of people that are still going to prefer Zoom over actually traveling is going to be the one that never comes back for airlines. But that being said, 43.30 is going to be that support. $47 is going to still be that resistance for Southwest. So Powell actually speaks at 10 a.m. Eastern, so in about 20 minutes here. We'll keep a close eye on the live stream if you can find one. And if you're able to actually listen to him for a while, we definitely will, and what he has to say. But if not, then I will definitely most certainly be doing like a summarized video, 10-12 minute video going over what exactly he said and what exactly Janet Yellen said about fiscal policy as well, because that's really going to be the two sort of arms of the US economy, fiscal policy and monetary policy, and they essentially control it. So I think it's very important for us to get their thoughts, get their direction, what kind of guidelines they're giving us, and where do they see economy and the markets going in the future. I think that's going to be very important. Walgreens coming down. Not a surprise. A lot of the retailers are also pulling back because of the new variant. So it's kind of like what we're really seeing is some of the tech stocks pushing higher, and some of the recovery plays were selling off on the fears of on inflation, on the fears of variant, not inflation, the fears of new variant. And of course, last week when we first heard about it, airlines were down 10% plus on that day. And of course, retail has obviously been selling off, with Walgreens also pulling back over 10.7% in the last 25 days. So $45 is still going to be that support level to watch. Resistance stays put at close to $51. And all the way around $39. So $39 closer to $40 is going to be that next support level to keep in mind for Walgreens as well. Still undervalued, strong dividend play in my opinion, and I will consider kind of dollar cost average for this stock. So Richard, I am in Manchester right now. So all right, Caddy, do you think anything out there is margin worthy at these levels? That's a great question. That's actually one of the best ways somebody's asked me, margin worthy, because this is like a different type of question. It really depends on your conviction level. Like Vertex to me remains really undervalued here. And of course, biotech, it's not the year for biotech. 2021 has just not been the year for pharmaceuticals or biotech, right? Some of the companies have done well, right? Considering Moderna, considering Pfizer, some of those companies have still rallied. But if you just take a look at just general biotech, XBI, which is the S&P 500 biotech ETF, down over 18% year to date. and just been selling off since February, right? Since we saw that rotation, it's been selling off, right? 174 all the way down to 117. If you take a look at ARKG, also just absolutely got destroyed this year, down about 31% so far from all-time highs of 114. It's down over 44%. So I think Vertex kind of falls in that same category. It's not the year for biotech, but eventually, just considering how low valued it is for stronger growth and great management, I do think that Vertex is still worth picking up at these prices, right? My price target, I forgot when I did a video, I think it was a little bit over $400, but I could be mistaken. Make sure that you do watch that video as well. I'll have to rewatch my own video to kind of go over what type of analysis I did and what kind of multiples I assigned it. And then, yeah, so a lot of upside for me. But still, margin worthy really depends on your conviction level, because it's at the end of the day, you're the one taking out the margin, so it's important for you to get comfortable for that stock. That's the bottom line. If you're not confident in any of your positions, it's not worth having, because you're going to lose sleep over it. You're going to think about it. You're just going to constantly worry about where it's going. So essentially build that conviction level in that company. Read about it, learn about more what the business is, what the fundamentals are, who runs the company, what kind of growth are they foreseeing, what type of growth they have. Are they keep meeting up with their promises? Sort of like those things. Dilution, what's the situation with that? What kind of free cash flows are they generating? What type of EBITDA? So all of that is really important so that you can continue to stay confident when the prices are coming down, right? So for PayPal, right now, yes, it's really unfortunate and I'm hurting, but at the same time, I feel confident because the business remains strong. So, I'm not in a state where I would panic about PayPal because the fundamentals are still growing. The underlying business is still strong. And I do understand why it's coming down. It's the valuation, right? We've talked about this. Valuation, 16 times sales, that was high. And now it's trading at 9. And sooner or later, people will realize that it is trading at low valuations for what it can bring in terms of growth in the future. And hopefully that's the expectation that eventually it will get bid up and push back higher to $300, $350, back up to new all-time highs. So really important for us to kind of go over that. Nithi, thank you so much. Yes, I'll give your regards to those two players. If I actually do meet with them, which obviously is not possible, but yeah, we'll definitely do that. So, all right, let's take a quick check on the markets. We are just going back and forth for the first 15 minutes. Nasdaq still about flat here, down about 26 basis points. S&P still down over 60, and we get the Dow Jones down about 246 points, pretty much giving up most of the gains from yesterday. The Dow is. And from our all-time high levels, the S&P 500 just coming back down, and we are down a little bit over 2.5% from all-time highs. The Nasdaq may be down a little bit more, down over 2.9, and the Dow Jones is actually down quite a bit, 4.5%. So the Dow Jones is actually not necessarily in that pullback, but it is closer to a pullback than the S&P, the Nasdaq. Nasdaq, S&P is still down over 2.5%, still in that dip category. But the Dow Jones is just entering that pullback territory. If it breaches over 5%, then I think it will be a decent pullback on the Dow. All right. So, all right, let's see. My take on Baba. We've already talked about Alibaba quite extensively on the channel, but let's see. So, main reason about Alibaba's sell-off, it's hard to say. I mean, it all kicked off with the earnings here recently. Earnings, they gapped down over 11%, which obviously this time around, I think this was the first time, like I said earlier, this was the first time we saw Alibaba sell off on earnings. Previously, it was selling off on all the investigations, the regulatory issues, all the authorities kind of giving a hard time to Alibaba. That was one of the reasons that it was selling off. But this was the first time in a long time that Alibaba sold off on earnings. And earnings, I want to say it was like mixed earnings. We did see some material impact of the fines that they've been paying. So earnings dropped, cash flows dropped, EBITDA dropped. So those things definitely, the bottom line got hurt. The revenue still grew. But overall, I mean, it still remains undervalued, regardless of how poorly the earnings were reported. At 130 and market caps under 370 billion, it still is undervalued. And of course, the delisting, rumor got piled onto this company even more, which I don't personally think the odds are very, very low, very low. I would be honestly very shocked if it were to go through. for Alibaba. So then we got the Pelotons up over 3.7%. How is Zoom doing? Zoom is flat on the day so far. Oil continues to sell off here, with Chevron, Exxon also pulling back. Not a surprise because oil prices are down. And then let's take a look at the sectors. So on the day, we've got Bitcoin higher, up over 2.2%. Then we got the 10-year yields down the most, with bond prices getting bid up a little bit. Energy and tech up over 40 basis points. And we got discretionaries, materials, energy, industrials, and financials also up anywhere between 1 and 1.5%. Utilities are down, healthcare is down, and staples are also pulling back on the day. Yes, I do have a video on Matterport in the past. Yep. So up another 1% here. So $24, $25 getting validated here for the stock. So on a nice sort of like this uptrending channel where it just continues to make this push higher, comes back down to validated support, pushes higher, makes the all-time highs, comes back down to a support, pushes higher. So that's exactly what we're seeing right now. So 50 EMA validation, we pushed up. 50 EMA validation, we pushed up. 50 EMA validation, then we're pushing higher once again. So nice consistent rally for Matterport. The R side just a little bit over 71, and MACD also pushing up here as well. I think I did a video on Matterport in the past. It should be like in stocks under 30 minutes playlist on YouTube. Let's take a look at EA. So EA just at support, 124 is going to be that level to watch right there. And just a lot of sideways trading for the company, right? This was a lot of consolidation, a lot of back and forth before we saw that drop for EA. Then we essentially rallied back up closer to 16% upside, and right now we're back down to those levels with the RSI, the MACD also very oversold, looking for a potential reversal here, back up to 136 or $150 per share. Those right there are going to be two resistance levels to keep in mind for EA. Support level is going to stay put at close to 124. How is Upstart doing? $215 up over 1.3%, so not bad. Pushing higher. Coinbase is up, Tesla's up. TrueLeaf is up over 3% now, so decent gain on TrueLeaf so far. NEO's up over 1.5%, so that's good. And we got Upwork pushing higher. ARKG, Twilio, Take-Two Interactive, Square, PayPal. A lot of the markets are still down, but a lot of the stocks are green. Surprisingly, Apple, Amazon also green. AMD also green. Fubo TV just down about 1% here. $20 is going to be that next support level to watch. What stock would you YOLO in? Hard to say. I don't know. Yeah, it's hard because, yeah, I don't really, it's not for me, honestly. If I'm ever investing, I would like to know like the details of everything. I would like to know like a lot of things about that company. But Fubo, you can kind of say that Fubo is a riskier swing trade. I still have learned about the company over time, but I feel like it is one of the riskier plays. Wouldn't necessarily be a YOLO, but it is risky stock to begin with because it trades at a low valuation. So from a valuation standpoint, it's not that risky, but the short interest is high. Shares sold short are also high for Fubo, and the profitability is not quite there. So the earnings, the earnings and the EBITDA, the cash flows are not quite there. So Fubo TV can be considered as a riskier play, but $20 is going to be that support, and I will be dollar cost averaging at $17 and $15 for the stock. My goal would be to get the dollar cost average somewhere between these levels. So the goal with Fubo would be to get my average cost somewhere between $17 and $15. If I can get it closer to here, considering that it sells off all the way down here, I think I should be all set with Fubo TV as a potential reversal in the future, because the upside would be tremendous at those levels, right? Even from $15 back up to $30, that's 100% gain for the stock. So the goal would be to get it between $15 and $17. So let's see, ABML. So American Battery Technology Company, seems like an OTC stock. $1.24, 777 million market cap. So wow, okay, so it has no revenues. Okay, so are we putting out YOLO prospects? Is that what we're doing? Are we putting out prospects or stocks that are a good fit for a potential YOLO, because the volume is really low for this stock. So I don't think it's worth covering right now. But let's take a look at MasterCard. MasterCard also selling off, down about 1.8%. So Visa, MasterCard, PayPal, some of the fintech companies, payment processing companies, they have just been selling off quite a bit. And there's been fears about, cryptocurrencies, of course, disrupting their business model. But I also do think the valuations in general got too high for some of these companies, right? So if you come over here, let's take a quick look. So let's just go over to statistics or market caps. Yeah, let's just go over to this one and let's just talk about PayPal. By the way, this is Neo's chart, bullish pennant, or kind of like a descending triangle as well. Let's see if you actually do get that breakout for Neo from these levels of just over 2%. But let's see. So this is the weekly chart, and even on a weekly basis, I feel like the RSI, the MACD has come down to very, very low levels. So on a weekly chart, the relative strength index is at 26 for PayPal, which is incredible. For Visa, I think it's the same situation. We're coming down to very low levels. Yep, so RSI is just over 30, so oversold on a weekly RSI basis as well. But that's not why we're here. I just wanted to take a look at the price to sales ratio for this. All right, price to sales right there. So you'll notice that Visa was in fact at 23. That is absolutely insanity right now. 23, almost 24 times sales, which was incredibly high. Take a look at MasterCard. Same story. It was at 25 times sales, which was really high. And of course, I mean, we've seen companies that trade at ridiculous numbers when it comes to like Snowflake. It was trading at over 223 times sales before finally contracting, and even right now it's trading at about 120, 150 times sales. BNGO, right? Another really, really high pick. At one point, it was at over 307 times sales, which is astronomical, right? From traditional metrics. Right now, it's just over 60. But you'll notice how much multiple compression we've seen for these companies, right? This is the valuation coming down over 76%. Because it was really, really high at those levels. So MasterCard, Visa, PayPal coming down simply because of, in my opinion, the valuation got really high. And of course, there's also pressure from cryptocurrencies kind of disrupting some of their business model. And that's what's getting priced in right now. So what is a good price to sales ratio? That's a great question. Really depends on a couple different factors. It depends on the industry that the company belongs to, right? So retail in the past, since it has low margins, usually demands a lower multiple, right? So industry sort of represents the margins that the company can generate, and margins as a result demand a certain multiple for that company. If the companies generate very, very high margins, they can demand a higher multiple, such as companies like Visa, MasterCard, PayPal, Apple, Facebook, companies like Microsoft. They can demand a higher multiple because their margins are really high. But then companies like Amazon, from an earnings standpoint, yes, but from a sales standpoint, they can't quite demand a higher multiple because the margins are very, very low for that business, right? So it's important for us to kind of do that distinction between different companies. Even banking, for that matter, doesn't usually trade at high price to sales multiple because of the lower margins that they generate, right? Because they've got very, very small margins that they're working with. So it's all like give and take between different sectors, different industries, different companies. But sometimes, yeah, a lot of companies will trade at overvalued levels and they will sustain those levels for very long. I mean, if you take a look at NVIDIA here, NVIDIA trades at over 34 right now, which is much higher than Visa or PayPal. Why is that? It's because not only is the company has high margins, but it's also growing at a very rapid clip, much higher than Visa, PayPal, MasterCard, probably combined. I mean, NVIDIA's growth has just been phenomenal, right? That's why when you put together the whole package of high growth, quality company, great management, great balance sheet, great earnings growth, everything perfect, trades at a higher multiple. Same with Advanced Micro Devices. It's actually back up to that same multiple that it was before when we saw that correction back in December 2020 for Advanced Micro Devices, 13, almost 14 times. So really high. SoFi trades at 26, although it has come down from 55 levels. So we have seen a little bit of a pullback of 50%, but the company itself hasn't seen a 50% drop. I think it's only down a little bit over 34%. That really means that even though the multiples compressed over time, the sales have grown for the company. So stock price coming down, sales growing, and that narrows that gap between the price to sales multiple. So NASDAQ green, there we go. The NASDAQ pushing higher, up over 6 basis points. We got the S&P also trying to turn green, a lot of green candles coming up. And we got that meeting or Jerome Powell's speech starting in 2 minutes. Let me see if I can pull that up somehow. Let's see. By the way, let me know if you guys can hear that. Just give me a thumbs up if you guys can actually hear that. Right now, I don't think they're talking right now, so we'll just keep it on watch. So this is the 10 a.m. Testimony, Chair Jerome Powell before the U.S. Senate Committee on Banking, Housing, Urban Affairs today. So that should be November 30th. So we'll be watching that live. We'll see how much we can get through together. But if not, then we'll definitely, I'll be going over. I'll share this link with all of our Discord members so you can actually watch it by yourself if I'm not actually going over this. But definitely after the event, I will be going over what he actually said as well, because my battery is about to die. 13% left. Hopefully we're able to at least get this started. And then I'll share the link and I'll watch it again. All right, let's take a look at AT&T. I feel like a lot of people are talking about that stock. So AT&T dropping another 3% today. Wow. Yield is still higher, 8.5%. They are going to be partnering with Discovery next year. The deal is expected to close in the middle of next year. I think the payout ratio is expected to drop for the company. Right now it's at 60%, but they're expected to drop that down to 40%. Might be even a little bit lower. So dividend yield is definitely going to see a bit of a cut for the stock. And that's been one of the most attractive pieces for AT&T is the dividend yield, right? The growth has been okay, but the yield is what's really kind of attracting a lot of investors. But now we're seeing kind of that go away. That's why we've seen a lot of pullback here for AT&T from recent highs from May. We've sold off a little bit over 32% for the company as well. So just a lot of momentum to the downside for AT&T. Next support I have is at closer to 19, closer to $20 for AT&T. So Jay Powell, somebody said Jay Powell would be like, due to supply chain issues, I'm out of ink for the printer. That's hilarious. So yeah, as soon as this starts, I'll listen in on it with you guys. Janet Yellen's expected to be there too, kind of going over the Treasury Secretary and going over the fiscal policy as well, and their thoughts on inflation. This is, by the way, the first time I think Jerome Powell is going to be speaking after the inflation report and after employment. By the way, employment also comes out on Friday. That's the first Friday of the month on December 3rd. And right now we're just over 4.2% for unemployment. Yeah, the speech is released. Bert, yep, you're right. We went over that yesterday. We do have prepared remarks that he's going to be talking about, which obviously he mentioned that the new variant is going to be very, very concerning to monetary policy, potentially pose a risk for unstable dual mandate the U.S. economy has towards prices and employment as well. VIX really has been coming down, just over 6.44%. We were much higher over 27.5%.
Housing and Urban Affairs will come to order. Today's hearing.
Just give me a thumbs up if you guys can hear that.
Hybrid format, or witnesses are in person. Members have the option to appear either in person or virtually. For those joining remotely, a few reminders. Once you start speaking, there'll be a slight delay before you're displayed on the screen. Please click the mute button to minimize background noise. all of you have been through this before, so I don't think I need to lay out all that we're doing. Our speaking order, though, will be as usual. That is by seniority, the members who've checked in before the gavel came down, either in person or virtually. And then by seniority of members arriving later, alternating between Democrats and Republicans. Last week, many Americans sat down with family and friends to celebrate Thanksgiving. I start with taking a moment to thank the workers who made that possible, many of whom didn't get the day off. Farm workers, grocery store workers, restaurant workers, auto workers, delivery workers, longshore workers, so many others who touch our lives. These are the people who make our economy work. It's something that the Treasury Secretary and the Fed Chair need to always keep in mind. Under the Biden-Harris administration, our economy is bouncing back. It's getting stronger every day. We created 5.6 million jobs this year. The unemployment has dropped to 4.6%. Weekly unemployment claims dropped to under 200,000 last week, the lowest level not just since the pandemic began, but in over 50 years, since 1969. Of course, raw jobs numbers alone don't tell the whole story. They don't tell you how good the job is, what kind of wage it pays. And on that front, the news is even better. Workers are starting to finally get a little more power in our economy. Last year, corporations called their workers essential, then many turned around and cut hazard pay, if they ever offered it at all, and cut corners on safety to make sure their profits didn't take a hit. Or worse, they laid off loyal, longtime employees in the midst of a public health crisis. They can't make those record profits without someone to actually do the work, though. Today, American workers are demanding what they've earned. After years of stagnant wages, of shrinking benefits, of no control over their schedules, workers are standing up for themselves and for each other and asking for their fair share of the profits they create. We just saw the United Auto Workers win better pay and better retirement benefits after a 5-week strike of John Deere. It was good for non-union employees too. This is typical, who get a bump in their pay too. For too long, corporate greed has kept paychecks down and prices up. Corporations cut costs at workers' expense to juice quarterly earnings numbers, even when they're already plenty profitable. Executives reward themselves with record profits and stock buybacks, while arguing they can't afford to pay higher wages to anyone else or can't afford to lower prices. During a once-in-a-generation global pandemic, despite the supposed labor shortages and inflation fears, Wall Street banks and corporations still managed to rake in record profits. Profits at the biggest U.S. companies shot above $3 trillion, $3,000 billion this year. The margins keep growing, and now while working families are just starting to get back on their feet, mega corporations would rather pass higher costs on the consumer than to cut into their already large profits. To continue the progress we made, we need to rethink the old system. The Biden administration is creating jobs and bringing down costs for families to build a resilient economy for the long run. The biggest costs families face have been rising for years, in many cases, decades: housing, healthcare, prescription drugs, childcare, preschool. The Democrats' agenda will bring down these costs. We passed the American Rescue Plan, which got shots in arms and money in pockets, including the child tax credit, the largest tax cuts for working families ever, that's helped millions of families afford child care and keep up with the cost of living. 90% of families in Pittsburgh and Cleveland and Toledo and Philadelphia, 90% of families with children under 18 are getting at least a $3,000 tax cut. We passed a bipartisan infrastructure bill to upgrade our ports and transit systems, to revitalize manufacturing here in the U.S., to secure supply chains, to create millions of good jobs. 2 weeks ago, the House passed Build Back Better, which will bring down child care and housing and health care and other household costs. Now the Senate and extend the child tax credit, the biggest tax cut, as I said. Now the Senate must act. The ongoing pandemic has exposed long-standing weaknesses in our supply chain, global supply chain disruptions and increased demands. as our economy rebounds are causing higher prices in certain sectors. Secretary Yellen and Chair Powell are keeping an eye on this. The more we get the virus under control and understand its variants, the faster we'll see these disruptions subside. We're already seeing some progress. The bipartisan infrastructure plan's investment in our ports will help speed up our supply chains in the long run. Passing my Supply Chain Resiliency Act would further reshore and strengthen U.S. supply chains. There's also an even simpler short-term fix available. Corporations could lower their prices. Executives could get a slightly smaller pay bump this year. Stock buyback plans could be put on hold instead of raising costs for customers. Again, that's the choice they face. They could take a slightly smaller pay bump this year. They could cut back on their stock buyback plans, actually put them on hold instead of raising costs for consumers. There's no inexorable law that says profits for those at the top must continue to rise and rise and rise in perpetuity, even at the expense of everyone and everything else in the economy. Corporations can get away with it. We know this. I've had these conversations with Chair Powell and Secretary Yellen. They can get away with it because they have too much power in our economy. That makes it all the more vital that we not pull back on empowering workers. The Fed can't pump the brakes on our economic recovery too soon before workers get a chance to fully rebound. And I mean all workers. Women who finally started to make significant job gains last month, disproportionately forced out of the labor market as many took on the extra jobs of full-time caregiver and homeschool teacher. The black unemployment rate's still twice that of white workers. That's increasingly unacceptable. A resilient economy is an economy where full employment means everyone can get a job, a good job that pays a living wage, allows you to build a career and raise a family. It's an economy where everyone shares in the benefits of growth, where our progress isn't gambled away by Wall Street greed. Instead of doing Wall Street's bidding, we all, and I include the Fed, the Treasury Department, and this Congress, we all need to support the institutions that work at serving their neighbors and contributing to the real economy. That means supporting small business. It means creating paths to home ownership. It means supporting institutions like MDIs and CDFIs that serve communities that the banks ignore. That means making sure that workers have power in our economy and share in the prosperity they create. Corporations and their allies in this building, and there are a whole lot of them, want you to believe we have to choose between high wages and low prices. That's a false choice. We can have an economy where you earn a living wage and you can afford the things you need to live: childcare and healthcare and education and housing and groceries. Our economy can be a reflection of our values as Americans, ones that recognize every worker's potential from all walks of life, from every corner of our country. President Biden recently announced his intention to renominate Chair Powell to lead the Federal Reserve and Governor Lael Brainerd to be the vice chair. They've helped lead our economy through the pandemic. I'll continue to work with both of them and the next Federal Reserve nominees that reflect the diversity in thought, in gender, and race, the diversity of our country. I look forward to hearing from the Secretary and the Chair on how they plan to build a resilient economy that works for everyone. Senator Toomey.
Thank you, Mr. Chairman. Secretary Yellen and Chairman Powell, welcome back to the committee. Chairman Powell, congratulations on your renomination. Despite our several disagreements, I look forward to supporting your confirmation. When the pandemic hit in 2020, Chairman Powell acted swiftly to stabilize financial markets and the economy. He also implemented a number of sensible regulatory reforms that helped to spur economic growth. And for those who would criticize those efforts, I suggest they look at the past 2 years. Our economy and our financial system experienced a very severe real-world stress test during the worst days of the pandemic. And we came out of it with the best capitalized banking system in American history. While I support Chairman Powell's renomination, I'm very concerned about whom President Biden may nominate to fill other seats on the Fed board, given some of the radical financial regulators he's nominated so far. Just consider his radical nominee to serve as the comptroller of the currency, the nation's top banking regulator. Members of the Fed board ought to have exceptional qualifications and an appreciation for the Fed's narrow statutory role on monetary policy and banking supervision. We need Fed nominees who are focused not on social policy, but rather the alarming bout of inflation that we are currently experiencing. Inflation is at a 31-year high. Just last month, the Consumer Price Index increased by 6.2% year over year. Price hikes are everywhere, from the cost of a Thanksgiving meal, which rose by 14% over last year, to the pump, where gas has reached as high as $6 a gallon in some places. And inflation is a tax that's eroding Americans' paychecks every day. Even though wages are growing, inflation's growing faster, and that's causing workers to fall further and further behind. I've been warning about the risks of higher and more persistent inflation since January. Unfortunately, the Fed has decided to continue its really emergency monetary policy, adding fuel to the inflationary fire long after the economic emergency has passed. Earlier this month, I was glad to see the Fed finally announce a long overdue taper of its bond buying program. Quantitative easing should be used in emergencies only, and we are well past the need for such support. Our economy took a nosedive in the second quarter of last year, but by the third quarter of 2020, it had largely recovered. And yet here we are in November 2021, and the Fed's still buying more than $100 billion in bonds each month. The Fed should have started tapering nearly a year ago, but instead it's expected to continue buying bonds through next June. And on interest rates, which are currently near zero, the Fed is still maintaining a wait-and-see approach. I am somewhat relieved that Chairman Powell has recently spoken about the heightened risk of higher and more persistent inflation and has indicated his determination to control it. Unfortunately, the Biden administration and many of our Democrat colleagues in Congress are not willing to do their part to limit inflation. Instead, they're exacerbating the problem and then blaming inflation on their usual suspects, greedy corporations. Apparently, some of my colleagues believe that companies were for years generously leaving money on the table and only now have thought to raise prices to maximize profits. Well, this is a cynical fib meant to distract from the fact that Congressional Democrats' extremely liberal policies are contributing to the price hikes hitting Americans' wallets. Just take energy prices, for example. President Biden kicked off his presidency by taking measures to curb our nation's energy supply. He terminated construction of the Keystone Pipeline, a tremendous source of oil. He placed an indefinite ban on new oil and gas leases on federal land. Meanwhile, on the demand side, the administration and Democrats in Congress have propped up demand for energy with their March 2021 $1.9 trillion stimulus bill. It's no wonder then that Americans are seeing skyrocketing energy prices. When you decrease supply and then subsidize demand, prices go up. That's basic economics. Unfortunately, the administration has not learned its lesson. It's still pushing a multi-trillion-dollar reckless tax and spend plan that will contribute to more inflation and damage our economy. Its plan is a massive expansion of the welfare state, and it will partially be paid for by large tax increases that'll hurt American families and make the U.S. a less competitive place to do business. The intent of this plan is to fundamentally transform the relationship between the federal government and the middle class. It's about socializing many ordinary responsibilities that middle-income families have always assumed, including by providing free preschool, free paid leave, free childcare, just to name a few. Democrats are attempting to hide the unprecedented enormity of this tax and spending spree through budget gimmicks. According to the nonpartisan Penn-Wharton budget model, the House version of the Build Back Better plan will cost $4.6 trillion over 10 years if the bill's temporary provisions are made permanent, as the Democrats plan and hope. As Senator Manchin has noted, Democrats are using, quote, shell games, end quote, to hide the true cost of this inflation. I hope that Democrats will reconsider their misguided efforts to double down on the reckless spending that has contributed so much to the highest inflation that Americans have experienced in 31 years.
Thank you, Senator Toomey. I'll introduce today's witnesses. We will hear from Treasury Secretary Yellen, Federal Reserve Chair Powell, and their agencies' continued actions to recover from the pandemic and build a resilient economy that works for all Americans. Thank you both for your service. Congratulations again to you, Chair Powell, and thank you for your testimony today. Madam Secretary, if you'd begin. Thank you.
Chairman Powell, Chairman Brown, Ranking Member Toomey, members of the committee, it's a pleasure to testify today. November has been a very significant month for our economy, and Congress is a large part of the reason why. Our economy has needed updated roads, ports, and broadband networks for many years now. And I'm grateful that on the night of November 5th, members of both parties came together to pass the largest infrastructure package in American history. November 5th, it turned out, was a particularly consequential day because earlier that morning we received a very favorable jobs report, 531,000 jobs added. It's never wise to make too much of one piece of economic data, but in this case, it was in addition to a mounting body of evidence that points to a clear conclusion. Our economic recovery is on track. We're averaging 500,000 new jobs per month since January, and GDP now exceeds its pre-pandemic levels. Our unemployment rate is at its lowest level since the start of the pandemic, and our economy is on pace to reach full employment 2 years faster than the Congressional Budget Office had estimated. Of course, the progress of our economic recovery can't be separated from our progress against the pandemic. And I know that we're all following the news about the Omicron variant. As the president said yesterday, we're still waiting for more data, but what remains true is that our best protection against the virus is the vaccine. People should get vaccinated and boosted. At this point, I'm confident that our recovery remains strong and is even quite remarkable when put in context. We should not forget that last winter, there was a risk that our economy was going to slip into a prolonged recession. And there is an alternative reality where right now, millions more people cannot find a job or are losing the roofs over their heads. It's clear that what has separated us from that counterfactual are the bold relief measures Congress has enacted during the crisis. The CARES Act, the Consolidated Appropriations Act, and the American Rescue Plan Act. And it's not just the passage of these laws that has made the difference, but their effective implementation. Treasury, as you know, was tasked with administering a large portion of the relief funds provided by Congress and under those bills. During our last quarterly hearing, I spoke extensively about the state and local relief program, but I wanted to update you on some other measures. First, the American Rescue Plan's expanded child tax credit has been sent out every month since July, putting about $77 billion in the pockets of families of more than 61 million children. Families are using these funds for essential needs like food, and in fact, according to the Census Bureau, food insecurity among families with children dropped 24% after the July payments, which is a profound economic and moral victory for the country. Meanwhile, the Emergency Rental Assistance Program has significantly expanded, providing much needed assistance to over 2 million households. This assistance has helped keep eviction rates below pre-pandemic levels. This month, we also released guidelines for the $10 billion State Small Business Credit Initiative Program, which will provide targeted lending and investments that will help small businesses grow and create well-paying jobs. As consequential as November was, December promises to be more so. There are two decisions facing Congress that could send our economy in very different directions. The first is the debt limit. I cannot overstate how critical it is that Congress address this issue. America must pay its bills on time and in full. If we do not, we will eviscerate our current recovery. In a matter of days, the majority of Americans would suffer financial pain as critical payments like Social Security checks and military paychecks would not reach their bank accounts, and that would likely be followed by a deep recession. The second action involves the Build Back Better agenda. I applaud the House for passing the bill, and I'm hopeful that the Senate will soon follow. Build Back Better is the right economic decision for many reasons. It will, for example, end the childcare crisis in this country, letting parents return to work. These investments, we expect, will lead to a GDP increase over the long term without increasing the national debt or deficit by $1. In fact, the offsets in these bills mean they actually reduce annual deficits over time. Thanks to your work, we've ensured that America will recover from this pandemic. And now with this bill, we have the chance to ensure America thrives in a post-pandemic world. With that, I'm happy to take your questions.
Thank you, Secretary Yellen. Chair Powell, you're recognized. Thank you for joining us.
Thank you, Chairman Brown, Ranking Member Toomey, and other members of the committee for the opportunity to testify today. The economy has continued to strengthen. The rise in Delta variant cases temporarily slowed progress this past summer, restraining previously rapid growth in household and business spending, intensifying supply chain disruptions, and in some cases, keeping people from returning to work or looking for a job. Fiscal and monetary policy and the healthy financial positions of households and businesses continue to support aggregate demand. Recent data suggests that the post-September decline in cases corresponded to a pickup in economic growth, and GDP appears on track to grow about 5% in 2021, the fastest pace in many years. As with overall economic activity, conditions in the labor market have continued to improve. The Delta variant contributed to slower job growth this summer as factors related to the pandemic, such as caregiving needs and fears of the virus, kept some people out of the labor force despite strong demand for workers. Nonetheless, October saw job growth of 531,000 and the unemployment rate fell to 4.6%, indicating a rebound in the pace of labor market improvement. There is still ground to cover to reach maximum employment for both employment and labor force participation, and we expect progress to continue. The economic downturn has not fallen equally, and those least able to shoulder the burden have been the hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on African Americans and Hispanics. Pandemic-related supply and demand imbalances have contributed to notable price increases in some areas. Supply chain problems have made it difficult for producers to meet strong demand, particularly for goods. Increases in energy prices and rents are also pushing inflation upward. As a result, overall inflation is running well above our 2% longer run goal, with the PCE price index up 5% over the 12 months ending in October. Most forecasters, including at the Fed, continue to expect that inflation will move down significantly over the next year as supply and demand imbalances abate. It is difficult to predict the persistence and effects of supply constraints, but it now appears that factors pushing inflation upward will linger well into next year. In addition, with the rapid improvement in the labor market, slack is diminishing and wages are rising at a brisk pace. We understand that high inflation imposes significant burdens, especially on those less able to meet the higher costs of essentials like food, housing, and transportation. We are committed to our price stability goal. We will use our tools both to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. The recent rise in COVID-19 cases and the emergence of the Omicron variant pose downside risks to the employment and economic activity and increased uncertainty for inflation. Greater concerns about the virus could reduce people's willingness to work in person, which would slow progress in the labor market and intensify supply chain disruptions. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we'll do everything we can to support a full recovery in employment and achieve our price stability goal. Thank you very much.
Thank you, Mr. Chair. Secretary Yellen, thank you for your comments about on the debt ceiling. We have 2 more weeks. We know failing to get this done will hurt families and small businesses and our whole economy. I want to ask you about something else, though. The Wall Street Journal reported 2 weeks ago that 2/3 of the largest publicly traded companies had larger profit margins in 2021 than in 2019 before COVID-19. In 2020, top CEOs made 351 times the income that a typical worker made. Even during an ongoing pandemic, when faced with increased demand and supply chain issues, big corporations refuse to cut their own profits. They raise prices on people. They complain about having to pay workers more, never mind the fact they've been giving themselves raises for years without it impacting their prices. Meanwhile, the costs of housing and medical care and almost everything else for most workers has been rising for years. You've said, Secretary Yellen, you've said the bipartisan infrastructure bill and Build Back Better will bring costs down for most Americans. Could you explain that?
Yes. The Build Back Better plan contains support for households to help address some of the most burdensome and most rapidly rising costs that they face. For example, the cost of childcare, which is virtually unaffordable for many American families. There are subsidies for quality childcare that will bring down the cost for the great majority of American families. Universal pre-K for 3 and 4-year-olds. And a child tax credit. And all of that will bring down the cost of childcare, and for families that are facing crushing burdens, for example, very high rental costs in many areas, the additional money that they get through the child tax credit will help them keep a roof over their families' heads. And as I indicated in my opening remarks, is already helping them put food on the table. With respect to the costs of caring for the elderly, Build Back Better contains support for those who are disabled and the elderly to get care in their homes. There are subsidies, an increase in the Pell Grant, and money for education and for workforce training that will make that more affordable, and reductions in the cost of prescription drugs. These are some of the most burdensome items in family budgets, ones that have risen more rapidly than the general level of prices over time. And the bill will help families meet those burdensome expenditures.
Thank you, Madam Chair. Madam Secretary, Mr. Chair Powell, is it still your belief that higher prices in certain sectors are chiefly caused by the upheaval we're experiencing as a result of the global pandemic, and that as the pandemic eases, so too should inflationary pressure?
So I guess I would say it this way. Generally, the higher prices we're seeing are related to the supply and demand imbalances that can be traced directly back to the pandemic and the reopening of the economy. But it's also the case that price increases have spread much more broadly in the recent few months across the economy. And I think the risk of higher inflation has increased.
Okay, thank you. The dollar is, this is a question for both of you, the dollar is controlled by the American people, but stable coins are controlled by opaque, secretive technology companies over and over on issue after issue. We've seen tech firms put profits ahead of the public interest with our elections, with our privacy, with competition in our markets. Is it risky, and start with you, Madam Secretary, is it risky to let control over our money fall into the hands of these companies?
I believe that stable coins can result in some greater efficiencies in the payment system, and could contribute to easier and more efficient payments, but only if they're adequately regulated. And the President's working group that I chair recently issued a report indicating that there are significant risks associated with these currencies, risks to the payment system, risks of runs, and risks related to the concentration of economic power. And we have called upon Congress to put in place for these stable coins, a regulatory framework that would make them safe and protect consumers and put them on a level playing field with other providers of similar services such as banks.
Chair Powell, do you agree with that?
Yes, I do.
Okay, thank you. In closing out my time, I think it's important to look at a bit of historical perspective, as both of you have explained to me in other conversations. In the late 90s and early 2000s, over-the-counter derivatives and subprime mortgages were billed as financial innovations. Financial regulators at the time pushed to weaken safeguards, saying that a cloud of legal uncertainty hung over the OTC derivatives markets, and regulations, again, their words, could discourage innovation and growth and drive transactions offshore. Later, the banking lobby argued that regulating subprime mortgages would decrease borrower choice and reduce access to capital. The Financial Crisis Inquiry Commission cited derivatives and subprime mortgages as key factors in the crisis. It looks again like the financial industry uses these same arguments for stable coins in decentralized finance platforms today. All of us on this committee in both parties should be concerned about that, should understand the historical parallels, and should listen to this very bipartisan panel, the Secretary of the Treasury and the Chair of the Federal Reserve. Senator Toomey.
Thank you, Mr. Chairman. Since the topic of the debt ceiling came out, let me just remind all of us of something that we know very well, and that is our Democratic colleagues can raise the debt limit all by themselves anytime they want, and there's nothing Republicans could do to stop them. The tools have been available to them all year long. And in fact, Republicans have offered to expedite the process. There is only one reason that our Democratic colleagues refuse to use reconciliation to raise the debt limit. And that is because they would have to specify the amount of debt they want to inflict on the American economy. They want to avoid accountability for this terrible spending spree they're engaged in by obfuscating and not specifying a dollar amount. I think we should be very clear about what's going on here. Mr. Powell, under the Fed's new flexible average inflation targeting, the inflation target remains at 2%, but now it's on an average over an unspecified time frame. Core PCE, the Fed's preferred inflation metric, is running about above 2% over the past 5 years, nearly 3% over the past 2 years, and 4.1% over the past year. So it's above target, it has been above target, and it's accelerating. Yet the Fed has maintained an extraordinary emergency monetary policy stance. It looks to me like this framework appears to be a weakening of the Fed's commitment to stable prices. Now, I know you believe this is transitory, but everything's transitory. Life is transitory. How long does inflation have to run above your target before the Fed decides maybe it's not so transitory?
Well, first of all, the test that we've articulated, I think, clearly has been met now. You're absolutely right. Inflation has run well above 2% for long enough that if you look back a few years, inflation averages 2%. So I think we can say that is taken. It was not the case going into this episode. It had been many years since we had inflation at 2%. So I think the word transitory has different meanings to different people. To many, it carries a sense of short-lived. We tend to use it to mean that it won't leave a permanent mark in the form of higher inflation. I think it's probably a good time to retire that word and try to explain more clearly what we mean.
Well, it still strikes me as just extraordinary that the economy it's long past recovery. We're in a full-blown expansion. Unemployment's down to 4.6. We have record high asset prices. Housing is leading the way to the point where in many markets, houses are just unaffordable for many people. And yet, the Fed's going to purchase $35 billion in mortgage-backed securities in December alone, and scheduled to continue purchasing mortgage-backed securities for months on end. I would strongly urge you to reconsider the pace of the tapering. Secretary Yellen, I want to follow up on the discussion about payment stablecoins. In the President's Working Group, payment stablecoins were defined. And the definition is, and I quote, Those stable coins that are designed to maintain a stable value relative to a fiat currency and therefore have the potential to be used as a widespread means of payment, end quote. Well, that certainly covers every major stable coin that exists right now. And what strikes me as perplexing is that the President's Working Group recommendation is that all such stablecoins be required to be issued by depository institutions only. But yet, as you know, the mechanism by which the value of the stablecoin is maintained relative to a fiat currency, they vary significantly. Some arguably look somewhat like depository institutions. Others look much more like money market accounts. Still others look like something wholly new. Why suggest that they all must be regulated the same way and treated as depository institutions?
Well, they all have the potential to be used as a means of payment, regardless of how they are used at the outset when they're introduced. And the structure that they espouse and adhere to, which is that they have a stable value relative to a fiat currency, that is really what depository institutions guarantee.
I would just suggest that we really think this through. I think the very fundamentally different designs suggest that there might be different regulatory approaches. I'm going to run out of time here. So, Mr. Chairman, I just want to note that Pillar 1 of the Biden administration's international tax agreement will be the most significant international tax change in 100 years. To implement it, every one of our bilateral our bilateral tax treaties would need to be modified. There is no historical precedent for bypassing the Senate treaty process to implement Pillar 1. Secretary Yellen, during a recent Finance Committee briefing, I asked you to acknowledge that administration would need to come to the Senate for treaty approval to implement Pillar 1. You responded that Treasury has yet to determine whether a treaty will be needed or not. In my view, and that of many of my colleagues, implementing Pillar 1 would require modifications to our existing bilateral tax treaties, and those modifications must be approved by 2/3 of the Senate. The executive branch cannot ignore the Senate on a matter that is clearly our constitutional responsibility. Thank you, Mr. Chairman.
Thanks, Senator. Senator Reid is recognized from Rhode Island.
Thank you, Mr. Chairman. And first, let me thank Secretary Yellen for being our guest speaker at the Providence Chamber of Commerce last week. Thank you, Madam Secretary.
Thank you.
And I learned something there. I always do when I'm with the Secretary. She is the only person that has been chairman of the President's Council on Economic Advisors, chairman of the Federal Reserve, and Secretary of the Treasury. So thank you, Madam Secretary, for your work. And let me, Chairman Powell, extend my congratulations for your reappointment to the Federal Reserve. Thank you. Chairman Powell, we've seen, as you both discussed, a steady job growth. What is troubling, though, is the labor participation rate has remained depressed. And until we get that participation rate up higher, we're going to have the complaints that we receive, the inability to get workers, et cetera. How do we do that? And what do you think are the causes of this fall off in the participation rate?
I didn't catch the very end of that.
The causes of the fall in the participation rate, and then how do we rectify those causes?
So it's very surprising. Since June of last year, the unemployment rate has dropped 6.5%, and participation has basically moved up to 0.2. It's sort of moved sideways, which was surprising. I think when unemployment insurance, enhanced unemployment insurance ran off and schools reopened and vaccination came, we all thought there would be a significant increase in labor supply, and it hasn't happened. So you ask why. There's tremendous uncertainty around that, but a big part of it is clearly linked to the ongoing pandemic. People answer surveys and they're reluctant to go back to work. They're reluctant to leave their caregiving responsibilities and go back to work because they feel like schools might be closing again, things like that. So it's an issue. And I think what I'm taking on board is that it's going to take longer to get labor force participation back. We're not going right back to the same economy. And really, it's going to take, often labor force participation is a lagging indicator. It follows big improvements in the unemployment rate. And we're probably on track to have that happen. And that means to get back to the kind of great labor market we had before the pandemic, we're going to need a long expansion. To get that, we're going to need price stability. And in a sense, the risk of persistent high inflation is also a major risk to getting back to such a labor market.
Thank you very much. Madam Secretary, let me...
All right, guys, I'm actually going to watch the rest of this right now. I'll share the link over to our Discord right now. It's been a pretty long live stream, but of course, the markets are down here with the NASDAQ coming down over 19 basis points. We got the S&P also down a little bit over 42, and the Dow Jones still down a little bit over 186 points, and the VIX up over 7.4%. But trust me, I will be going over this in a separate video, kind of summarizing my thoughts. Very, very interesting sort of narrative. And the market, of course, pricing all that in, and that some of the questions were obviously very, very tough, but we'll go over that in our video. I'll share the link over at our Discord now. Thank you so much for being here. Really appreciate you guys. Make sure that you drop a like, subscribe if you're new here, and also check out the Patreon link down in the description below. The first week of the month in December is going to be here, so make sure that you join as well to get those real-time buy and sell alerts, market updates, swing trade ideas, and a lot of different things. And of course, the fundamental analysis course link is going to be down in the description below as well. I'm going to be jumping over to our Discord here shortly. So thank you so much for being here. Appreciate you guys. Hope you guys have a great day. I'll see you guys in the next live stream. Take care.